And I think whenever there's a crisis and people lose money, and we saw this in 01, 02, I saw it a little bit in August 98, definitely saw it on GFC, saw it in COVID before the Fed bailed everyone out and made some people that shouldn't have looked smart, but that's a whole other, that's a whole other thing. I think people are surprised when that happens, but it's all right in front of you. It's like in 06, 07, you could have looked at what was happening. Like there was like over 100% loan to value loans to houses. Like anyone could get a mortgage. There were all these mortgage ranges just pumping with no sort of, consideration for credit quality. And I think just the tunnel vision of ignoring sort of not only the risk units on that particular deal, but the risk units of what's around you. And I think that's one of the biggest mistakes that people make. And I don't know if people are surprised by that, but it's very hard to evaluate risk units if you're only looking at it through sort of one lens versus multiple lenses. That's what we learned back in 2001, 2002. We had all those 10 disparate businesses where no one was talking to each other. And that's why they were actually put together. I give David Vignier a ton of credit as one of probably the best CFO, in my opinion, ever on Wall Street. He is one of my mentors. He is exceptional, but we're the biggest investor out there back in the late 90s and early 2000s. And, there was a bunch of loss-making businesses from all these disparate principal investing businesses. And that's why Goldman put them under one umbrella. I think that pattern of not just thinking about things in a siloed way versus being able to look sort of the overall periphery, I think that's what we're going to be talking about sometime here in the next 2 to 3 years.